Welcome, everyone. This is our first ICF Real Estate Colloquium here at SOM, and today we're having a very stimulating conversation on the role of property tech in commercial real estate investing. And we're joined by our guest speaker, Darren Powderly, who's the co-founder of CrowdStreet, and our moderator, Francis Lively, who's the CEO and president of the LCP Group, and also Yale MBA class of 2015. So welcome back to Francis, and welcome to Darren. Before we get started, I'm going to mostly focus on the conversation here during our time, but let me just kind of set the stage by saying that CrowdStreet is a provider of online commercial real estate investment offerings and technology. Their role is really connecting investors with sponsors engaged in CRE deals across the US. Their platform gives more than 100,000 investors direct access to a broad range of institutional quality assets to diversify their portfolios. I think one of the key things here to keep in mind is that CrowdStreet's members can invest anywhere from a minimum of $25,000 to multi-million-dollar contributions to collectively fund property sales and financing. And as of December of last year, investors have invested a total of around $4 billion towards more than 700 projects on the platform. So Darren Powderly is the founder of CrowdStreet. He founded it in 2012, and over his now 20-year career, he's transacted about over billions of dollars worth of commercial real estate investments and enterprise software contracts. Before founding CrowdStreet, he served as president of Compass Commercial, which is a full-service commercial real estate services company, and he launched his career in software at Oracle in San Francisco. He's a graduate of Leeds Business School at the University of Colorado Boulder, a CCIM designee, which means he's a recognized expert in investment real estate, as well as a full member of the Urban Land Institute. So welcome, Darren. And then Francis is the CEO and president of LCP Group. Prior to LCP, he served as the VP and counsel at Landesbank Baden-Württemberg, where he led the restructuring and partial disposition of a $5 billion commercial real estate loan portfolio. And he's also practiced law at Shearman and Sterling. He's been involved with a number of marquee properties that you might have heard of, including Chelsea Market. And just as a shameless plug for future events that we'll be having at SOM in the real estate space, he's also the head of our Alumni Real Estate Association annual conference, which we'll be having in October 27th this year. So please, if any of you are around, please mark your calendars for that. So without further ado, let me just say that for today's event, the way it's structured is that Darren's going to offer us some opening remarks, followed by kind of structured Q&A between Francis and Darren, and then we'll reserve ample time at the end from questions from you all. So thanks again. Welcome, Darren. Appreciate you coming.
It's great to be here with you all. Thank you for having me. And the real estate industry is an awesome place to build your career. For those of you who are, in fact, interested in getting into commercial real estate as you look to what's next after graduation here at the Yale School of Management. So thank you for having me. I hope to just share with you some experiences that this combination of between technology and real estate, private real estate in particular. We'll talk a little bit more about the alternatives industry, how those things have been converging over the last decade or more, and where we are today, and some vision into the future about where some of the opportunities lie. So I thought, Francis, we're going to make this very interactive, and we look forward to your questions, but I thought I'd just start out with a little bit of a history of real estate investing, and especially like alternative investments. For those of you who have been tracking like what has transpired over the last, say, 20 years, we've seen this big increase, in fact, a massive increase in private equity. The big firms like Blackstone and KKR and Apollo, right? Well, with this, as the public markets have been more and more regulated and more difficult for companies to actually go public, that has opened a window for companies to remain private for longer and build valuations, and become larger and larger before they go public. And the need for equity in order to fund the growth of those businesses prior to going public, that industry has caused the private equity industry to expand greatly. And also within this space is private equity real estate. That's where we focus. And we have seen the same trend happening for different reasons, but a huge influx of private equity to fuel the development of our cities and of course all over the country where we live, work, and play, the built environment, and we've seen the advent of technology over the last 20 years as well fuel this opportunity for people to participate in the private equity real estate investments. So bit of my background was helpful as I graduated in the mid 90s, and I moved to San Francisco. And I moved to San Francisco. Actually, I was scheduled to come back to New York, where I grew up outside of the city, and I had some connections on Wall Street, and that's what I thought I was going to do. I thought for sure I would move back to New York. I'd work on Wall Street, spend my whole career there, and hopefully, things would go well. Because that's what people I admired when I grew up, did. Instead, I guess I took a left turn from Colorado instead of coming back to New York. I made a left turn, I went to San Francisco. San Francisco in the late 90s was incredibly energetic. Silicon Valley was just exploding in the 90s. San Francisco proper, the city, was just packed to the gills with young, talented people, and I wanted to participate with that. My friends and I, a lot of us moved there. And I spent 5 years in the technology industry, and then it was the best of times. It was the worst of times. I wound up, moving after the .com. If you study the history of what happened at that time, it just completely imploded. I mean, it was unbelievable, up and down trend at that time. And of course, we've been through a number of those since that time. But I got into real estate, and I spent a decade in real estate. And it was the convergence of those experiences, because I did some development, not quite as advanced in the type of projects that Francis does. I did some local stuff. I did, I bought some buildings, I fixed them up, I raised money from friends and family, we bought some land, we developed some medical office buildings and some restaurant and retail pad sites and so forth. So I was doing a lot of little things. I was also leasing, and I was a broker, I sold a lot of property. Those two experiences led me to found CrowdStreet, and I thought it was an awesome opportunity to participate in what I felt like was a good thing for society. So CrowdStreet is definitely, from the very beginning, the origins of the firm is an impact investing platform. It was founded post-GFC, the Great Financial Crisis. And again, you study history, you realize wow, that was a time when the system failed us. There was a systemic global financial crisis, and companies that were too big to fail, failed. And some of them were rescued or folded under the bigger companies, and the U.S. government had to, pump just trillions of dollars of stimulus money into the economy. And one of the things that was exposed to us as a society at that time was that, just to have your money invested, for example, in the biggest firms like Lehman Brothers, we'll just use that as an example because it was the famous failure, most famous of them all. There's a place for big, major, mega global financial institutions in the world, but there's also a place for the democratization, right? So if you could decentralize finance, and many of you are following the trends in crypto right now, which is an even more current trend within the decentralized finance trend. But at that point, there was no crypto. There was this idea of using the internet to decentralize finance. And we tuned into that specifically for the private real estate sector. We thought that it would be to the benefit of society to have individual investors to buy multifamily apartment buildings and office buildings and warehouses and self-storage units, basically all types of commercial and residential real estate that is meant for the purpose of investment real estate, so that you put your money in with the expectation of return on investment and return on investment. And we thought that was a really good thing to lean into. The technology had emerged starting in the 1990s with companies like Charles Schwab, visionaries like Charles Schwab, who happen to be like a hero of mine, a business hero. And that's also another thing. It's always good to, when you look out where you want to be 10 or 20 years from now, think about the people that you admire, what they've done in their career. And it's just like you have sports heroes or other heroes in your life, perhaps, have a business hero or five. Schwab was one of mine, and I thought, why doesn't anyone do what Schwab did in stocks and bonds for private real estate? And the answer was it was pre-Jobs Act and it wasn't allowed. And the Jobs Act was an act of Congress. It was one of the greatest pieces of legislation that came out of the Great Financial Crisis, and it permitted online portals, and it permitted the ability to advertise investment opportunities. Those two things, which was actually meant for entrepreneurs, for startup businesses to get money back into the system, stimulate the economy, because corporations at that time were not doing their job as adequately as they had in the past. So both sides of Congress, or both aisles of Congress, voted in favor of the Jobs Act, which was meant to stimulate the economy, get money into startup founders. Well, we applied that to real estate. We created an online platform, a marketplace, which helped individual investors meet real estate sponsors like Francis, and we wanted to help them, participate in private placements and invest in real estate, whether that be hospitality or the other asset classes like I mentioned. And we always knew it was a good idea. We thought it was a really, really good idea to participate in this democratization of finance, and that since we were experts in real estate, we could do it just as well as anybody else. It was a bold move, and for those of you who are thinking about entrepreneurship as a track in your career, I just highly encourage you to do that, to lean into it. There's so much amazing material out there. The people that I studied who are still very much admired in the academic world are people like Steve Blank at Stanford and his teachings, and people like Eric Ries, the lean startup methodology. And so we were students at that time. We went through an accelerated program of creating a new business in an online fashion. And it was a good idea. The question was whether or not we were going to be able to execute on that idea. So we got to work, and we wound up launching our first deal in 2014. And that was a senior housing development in all places. Like the place furthest away from Silicon Valley, I think, is Bloomington, Indiana. And that's where we did our first deal, ironically. It's like, person wanted to do the deal with us and try this new model that was quite unproven at that time. And we raised, basically behind the scenes, before there was a lot of automation and technology that we had built out, behind the scenes, we were banging the phones, sending out emails at 2 in the morning. It was a pretty big effort, manual effort, to raise $1.6 million to fund the development of this senior housing project. So that's the way entrepreneurship works as well. Until you get the technology to scale, you do things that don't scale, but they prove out your business thesis. And we were, again, students of that, like, test and iterate and improve. And 10 years later, I think it's fair to say that we executed on more things well than we got wrong, right? Because you're always going to get things wrong in the journey throughout your career, or if you consider a career in entrepreneurship. So I want to just shift the story to why real estate and how it fits within a diversified portfolio. And because we now have access through investment platforms such as CrowdStreet, but there are others, and we are seeing major banks like UBS and Morgan Stanley and Merrill Lynch, like they're offering alternatives to their clientele as well. The traditional 60-40 portfolio of 60% stocks and 40% bonds is appropriate for a portion of the population, but perhaps for more advanced or sophisticated investors who want to further, the diversification of their portfolio, now we have the alternatives. And so the major banks, as well as startups like CrowdStreet, are enabling that access to occur. And real estate as an investment class has a low correlation to stocks and bonds. It also has a lower correlation. So private real estate and public real estate, spend a moment on that. So there's the publicly traded real estate investment trust, REITs, and you can buy them on your Robinhood account, or any other account. They're easy, there's total liquidity, you buy and sell them. They're a wonderful way to get started, and I own real estate investment trust, publicly traded real estate trust in my own portfolio. Prologis is the industrial one. I think I just bought a little bit more of them a couple of weeks ago through my brokerage account. But I also own private real estate. And so private real estate and public real estate aren't necessarily correlated all the time. Over a year or so, or 6 months to a year or so, you start to see the balance, and there's a comparison between what are the publicly traded REITs doing and what is the valuation of private real estate doing. It's a comparison that is helpful to try to realize where asset classes are. But when you own a publicly traded REIT, that follows the market. And so if there's a steep sell-off in the S&P, your publicly traded REIT is going to drop X amount of percentage point in a given day. It has nothing to do with the underlying real estate. It has to do with the liquidity, which is a benefit, and it's also a detractor. So private real estate is uncorrelated to that. The other main reasons to invest in private real estate is increased returns. So we've done, and the industry has done, and CrowdStreet has performed its own analysis about what is the impact when you add private real estate to an otherwise, diversified portfolio. And if it's not 60-40 stocks and bonds, it might be 60-30-20 stocks, bonds, alternatives, and the overall returns of that portfolio increase. Right? And of course, that's a good thing, but also the volatility of that portfolio decreases. Two net positives to an investor. Again, another reason to add alternatives or private real estate to your portfolio. Real estate is well known as an inflation hedge. And today, that's on everybody's mind. How to keep up with the rising costs of our lifestyles. Real estate, specifically real estate like hospitality and multifamily, and self-storage, where you have the ability to increase rents relatively quickly to keep up with inflation. So self-storage unit, every time one of those units turn, they can increase the rents. Overnight, you can increase the rents at a hotel. Average daily rate can change really in real time and dynamic pricing. Multifamily apartments, typically a 1-year lease term. And so those types of assets within private real estate are an excellent inflation hedge, commonly known as. So the other thing I wanted to state in my sort of opening here is that CrowdStreet, as a young, innovative company, I mean, we're a decade old, but that's young in the realm of how we think. We think long term. We think like investors. So you have to think long term. You'll have times like this where it's scary if your current portfolio is being hit, but also enticing because there are good opportunities. And then you also have to structure the debt and the equity or your capital stack to withstand good times and bad times. But what I wanted to lead into is our support for universities across the country, because we think that this convergence of technology and real estate is just getting started. Again, I told you about Charles Schwab in the 1990s and the Jobs Act of 2012 and CrowdStreet's birth out of that Jobs Act. And that was 10 years ago, 11 years ago, and it truly is just getting started. But we spend time getting to know and helping supplement the education that you're receiving here at Yale, for example, but just with helping you understand the benefits of real estate, the benefits of building a diversified portfolio and doing it on your phone. Because this is the easiest and best way. You can buy shares of a real estate deal within seconds, and you never could do that before, and the future is very, very bright as far as we are concerned. And so we work with alumni, like Francis, we work with students, we have an internship program, we hire graduate students at CrowdStreet, and we help to build up their careers. Some of the universities that we work with have their own student-led funds, and we advise and we give them access to different real estate deals that they could purchase through their student-led funds. So I just wanted to give a sort of opening, sort of like, big picture, tell you a little bit about how CrowdStreet fits within that, the origin story of the platform. I think Francis and I are going to open it up, and we could talk a little bit more about more details and numbers and so forth, as we've worked together, so we have a really good experience together.
Yeah. No, thank you, Darren. I was going to, actually, we can pull that slide up, just give a quick overview of a real-life CrowdStreet deal that we did this past fall, just as an entree into the Q&A. And then we can dive more into CrowdStreet as a business, the real estate markets, and technology and real estate generally. But as Darren said, we're a sponsor at LCP. So what does that mean in a nutshell? We're a smaller group that goes out and finds real estate investment opportunities, and we generally put in 5 to 10% of the required equity in each deal. So our specialty is hospitality and net lease investments. So we're kind of on two ends of the risk spectrum in real estate. What's really interesting to me about real estate investing as opposed to investing in stocks is there's kind of a built-in inefficiency that you can capture as a real estate person. Darren might look at a building and see X opportunity, and I don't see it at all, and he captures that in a single asset investment. If we're all investing in REITs, we're studying the financial statements, we all have sort of the same information to make that decision. So to me, that's what's fun and cool about a career in real estate, and we fit in as a sponsor. Typically speaking, when we do a deal, we go to an investment fund that has $250 million to $1 billion to invest in real estate. And they have a team, an investment team that's looking at real estate as an asset class and other alternative asset classes as well. And they like to have a group like us to find, vet a deal, and we may have relationships in the industry. So we come in as basically a small general partner, operating partner, and we make our money on fees and promote. So that's our business in a nutshell. There's becoming, for us, a size of investment that it's inefficient or doesn't work at all to go to those funds. And this is a good example. For argument's sake, let's say less than $50 million, but we're talking about equity checks in the range of $5 to $20 million. These are too small for a lot of the funds to do, and it's just not an investment they're going to look at. But it's an investment opportunity that we think might be interesting, but it might be a little too large for us to do ourselves. So a broker came to us and said, Choice Hotels, which owns the Cambria brand, which is a lifestyle hotel, is building a brand new one in New Haven. Are you interested? I was very biased, so I said yes, of course. I went to school in New Haven. And they'll sell it to you at C of O for their cost. So they built it for $30 million, and they'll sell it to you for $30 million because they're not in the business of operating hotels. They're really in the business of collecting franchise fees, which we pay to them to keep it within that brand. So exciting opportunity, $30 million. We found 50% financing from an external party, and we had some capital ourselves to provide an internal loan. So the equity check became around $10 million, right in that space I was telling you creates a little inefficiency. And my partner and I loved the idea of CrowdStreet, and we'd never found a deal to do it, so we immediately went to CrowdStreet and said, we want this to be our first-time deal. First-time sponsor, they said, let's shoot for $5 million of investment. You can see the return profile that we sent out to them. We went through about 30 to 45 days of CrowdStreet vetting us. It was a very efficient process, but they were also very thorough. And we tell them about the deal, why we like it, what our business plan is, and then they go to an investment committee and decide, just like our fund partners would, is this something we want to market on the platform? When we got the good news that it was, I think it was on a Friday afternoon, I did a webinar with the interested investors from the platform. Our target was 5 million. We did a 1 o'clock webinar. By dinner time, we had our target. By Sunday, we were oversubscribed, and I said, stop, it's gonna mess up our capital stack because I have other people who want to invest. So it was a super success, very efficient. From that moment when the investors came in, they were ready to go. It was basically documentation at that point, and we closed within 30 days. So I can't say enough about how fantastic it was. It was probably the most efficient and easiest equity raise we've ever done in terms of process. And the investors are very sophisticated, ask great questions, and CrowdStreet does a great job in vetting both sides. So that's been a success. We opened that hotel. I think some of you are going to come to lunch there later today and for a tour. And we look forward, to doing more business. But one thing I wanted to really point out to you guys is we raised just over $6 million That was from 134 investors. The minimum investment size was $25,000. On average, it came to $45,000 per investor, and we had a few whales in the mix in the 250 range, over 200, over 150. So that's the process in a nutshell. But what I wanted to start off, just to give the students more background, is kind of how many investors do you have on the platform today, and how many have invested in deals?
Yes. Isn't that awesome? 134 individuals were able to, buy a hotel. And they, whether you get pride out of driving by, maybe you're a Yale alumni or Yale students, like, I own that hotel. I own a small sliver of it, but I own that hotel. And Francis is taking care of it for me, so I don't have to worry about, midnight calls that something broke, or, spending my week. Because Francis, he's got that taken care of. He's doing that stuff. Right? So you're a passive investor. You're investing with a very experienced person who has a track record, because he passed our due diligence and underwriting process, right? So we know that by a fact, and he's experienced to do these type of projects. So you are passive, but you've got a great general partner or sponsor taking care of you. So yeah, that's a great story. Actually, I'm glad you're recording this. That was a nice soundbite too. Sure. So. How many investors do we have? We have 260,000 people, just like you, who have registered for CrowdStreet. I encourage all of you, just go to CrowdStreet.com. It's free. There's a ton of educational materials there. We invite anybody to register and learn about real estate. You'll see all of the pitch decks, and you can watch webinars, and you can dig into the financials of an offering. That's the beauty of this online platform that is built upon the concept of general advertising, right? And so many of the college students that we mentor and help teach them, they just love that part. It's amazing to see professionals pitch their business models and pitch their plans, right? Because they're experts at that, and they're also experts at managing investors. So it's just a tremendous learning opportunity to supplement what you're learning here at Yale. 19,000 people out of the 260,000 members have written a check. And about 70% of them are repeat investors. And for the repeat investors, they have an average of 7 deals in their portfolio. And an average portfolio size of about $370,000. So those repeat investors are the ones that are fulfilling the vision that we had when we started the company, to help people build a diversified real estate portfolio online, and then to track how that portfolio is performing over the time. So an important point, the value proposition of the CrowdStreet platform is not only do you get exposure to these investment opportunities, and you can invest in a digital sort of straight through, quick, on your phone, wherever, format, but then you get to track your performance of your portfolio. So just as you would with, again, Robinhood, Schwab, Fidelity, like we recreated that for the private real estate space. And so if you had 7 deals in your portfolio, you'd see them all. You'd see them in a summary format, and then you'd dig into the details, and you'd get quarterly reports, and you'd see the economics. If you put, say, $25,000 in, you'd see the return, metrics in terms of the cash flow that's being distributed on a quarterly basis. So you'd see your annualized return and distributions. And then when that project goes to sell in the future, you'll see the appreciation that occurred during the hold period and what your return on investment has been, and the overall performance of your portfolio.
Is there a favorite investment class within real estate for your investors on the platform in terms of number of deals invested in, total, total capital raised?
Multifamily is by far and away the most popular. And we do about 45% of our deals in the multifamily space. And then beyond multifamily, there's other housing, such as mobile home parks, or student housing, or senior housing. So it crests above 50% when you include the other housing types. A new housing type over the last, I don't know, decade or so has been build to rent. and it's very popular in places where there's a lot of excess land, places like Charlotte, places in Florida, Texas, a lot of land available, and home builders are building communities of single-family residential for the purpose of just renting them out, not selling them. And so it's kind of like a horizontal apartment building. Everyone in there is a renter, and that's meeting the needs of the housing demands across the country, and that's also popular. Below that is industrial. That is, we like industrial a lot. We actually have a hard time finding as much as we'd like. It's super competitive. Most types of investors, and mostly institutional investors, are getting the bulk of industrial property, but because of e-commerce and most of your stuff is showing up at your front door, that stuff has to be stored somewhere. So the need for warehouses in this country has exploded over the last decade and only accelerated through the trends of the pandemic. We do a lot of, we've only done about 10% office, which on one hand, we're grateful to only have so much exposure to office. But at the same time, there's some office which is weathering the storm of office space very, very well. And you go to a place like Hudson Yards and you see all the big glass towers and very modern technology and sensors, the Internet of Things, and the most modern neighborhood in America. I was going to say the world, but I've not been to the Middle East, and I understand there's some pretty high-tech new developments in the Middle East. But at least for America, that's where office tenants want to be. And they're willing to pay 5 or 8 times as much in rent versus an old 1920s Class C, mid-skyscraper somewhere tucked in Midtown. They want out of that. That's suffering, that type of offices. And they want into the big, shiny new office building if they can afford it. And then really every other asset class. We like retail again, whereas for a period of time, retail was declining. We had too much retail in this country, and it was becoming vacated due to, again, the e-commerce trends. Now it's been the stock of retail, whether it be malls or shopping centers, has been culled and repurposed or knocked down. And the remaining retail, we're seeing a firmness and actually some new retail activity causing rents to rise, occupancies to rise. We like retail in certain settings.
And just based on your own experience working with institutional investors versus the retail investors on CrowdStreet, how do you view any differences or similarities in terms of risk profile, returns? Are they cash-on-cash focused, more IRR driven? Mm-hmm. What types of things are your investors looking for that maybe differ from an institution?
Right. So we have, in this example, 134 people that came together to fund $6 million of equity. Just even within those 134 people, it's a sample set, of the type of returns that they're looking for, but they spoke up. What they like is that's an opportunistic type of return profile. You purchased this upon certificate of occupancy, right? So you didn't have a track record of like this hotel is full every night, right? Like he's proving that out, and the returns here represent a value add and more like opportunistic return profile. I mean, if we can achieve 19% by owning and operating this hotel, that's outstanding. That's an outstanding return. Remember I mentioned earlier with the 60-40 stock bond portfolio? Well, that portfolio returns a little over 7%, right? And so if you add just this one, right, property is reflective of a higher risk return profile, then your overall portfolio is going to increase. Our investors like this type of profile. They like to participate in development. They like to participate in value add and opportunistic returns. Right now, they're asking us every day, like, where are the deals? Where are the good deals because of the interest rate spike that we're experiencing in this global economy? And real estate is such a highly leveraged asset class. There are deals forthcoming. There are deals today. So they tend to have a higher risk profile than some of the institutions that might be investing on behalf of pensions for teachers and firemen and police, for example, big pensions. They want more core real estate. They want preservation of that capital so that they can make their distributions to the pensions for all of the people that they're serving. And so that risk return, spectrum, we're a little bit in the middle to the right, if you will, or a higher risk return profile within our community than some of the institutions. You do see some opportunistic institutions out there, with dry powder ready to pounce on opportunistic type of real estate deals. But I think that's the thing that comes to mind when you ask that question.
Yeah. And, to touch on the returns on this hotel, just for your benefit. So if we were the ground-up developer, we would, or an investor in a ground-up development, we would demand a higher yield than this because you're taking on more risk. You're taking on the development risk. Lots of things can go wrong, cost overruns, time overruns, interest rate costs going up, et cetera. Pre-development risk vis-a-vis the city and getting approvals. We're buying this at C of O, so I love these kinds of hotels because theoretically there shouldn't be anything that goes wrong in the walls that you can't see because everything's new. All the systems are new, the rooms are brand new. You come to the hotel, you say, oh, it's a beautiful hotel. Yes, because no one stayed in it. Give it 5 years and it will have all the nicks that every other hotel has. The other thing we're doing to generate yield is, as Darren said, we're ramping up. So we're going from 0 guests to hopefully 70% occupancy. There's a lot of work and risk involved in that in terms of the time frame you think you can do that. The other reason this deal worked in this environment was we had access to 70% fixed rate financing at an attractive rate. That doesn't exist in the market today. So if you brought me a hotel to buy today in most markets, we're seeing negative leverage. What does that mean? The seller wants to sell at a cap rate of, say, 5 or 6%, and you can get a 50 to 60% loan at 7, 8, or 9%. The math doesn't work. You're immediately negative leverage day one, so acquisitions have become very difficult. So this was just a good set of circumstances and well-timed. And then, like I said, I was a little biased being a Yale grad. But talking about your customer acquisition model, I see you have 2 customers. I feel I'm a customer of CrowdStreet, and then there's the investors. How do you guys go about acquiring those customers? What technologies do you use? What have you learned from when you started till now?
Right. And you're right, we do have 2 customers. It's CrowdStreet started out as a marketplace with 2 sides, 2-sided marketplace in a very traditional, marketplace business format with sponsors like Francis on one side, supplying the marketplace with the real estate deal flow, and then on the other side, individual investors. And when you start any marketplace, Silicon Valley terms that the cold start problem. Like you've got 0 on both sides. And so you get a deal and you post it out there. Well, you need to fund that deal. That attracts some investors, and so you get some investors, and you get another deal, and you build it up like that. And so how we went about doing that for the sponsor side of the business, the real estate operator and developer side of the business, was old-fashioned, leveraging our network and just calling as many real estate owner-operator developers, I'll call them sponsors from now on, as we could. And luckily, I knew a bunch of them, and most of them thought CrowdStreet was a good idea. Some of them were like looking at me like I had 2 heads, like, no, I don't know if that's ever going to work, And usually with new ideas, innovative ideas, you'll get that. But so we just continued to reach out, attend conferences. We knew how to identify real estate companies. Like, if I just focused on the state of Connecticut, it wouldn't take me long, and because we have a decade, I actually know who most of the other developers and owner-operators are here in the state of Connecticut. But we put all of them in our Salesforce CRM system. Once we meet LCP and we put their names and contact information into Salesforce, and we just keep following up. And it's very, very sort of old school, in that regard. But then we have so much exposure and press releases and word of mouth over 1 decade, over 10 years, that has now that network effect even within the real estate communities. Organizations like CCIM, Urban Land Institute, we have a good reputation. We've done what we said we're going to do, and we follow through, and we have brought this new way of raising capital to sponsors. And so on that side, I'd say it's a lot more traditional than the other side of the business, which is how do we get people to sign up for CrowdStreet and tell 5 of their friends to sign up and then have them make their very first investment. Well, a lot of that has to do with thought leadership and search engine optimization and targeted paid advertising spend. A company named HubSpot, we also use HubSpot technology, and they wrote the book, basically. A guy named Dharmesh Shah wrote the book on demand generation, inbound marketing. So instead of on what I was telling you about on how we reach out to sponsors, what you really want is the sponsors to call you. And if you have the best content out there, when they Google, real estate private equity or internal, they were trying to, you guys maybe studying for a test, you look up a definition. What does IRR mean? And then CrowdStreet happens to be, the first search result, the organic search result. And you click on that, next thing you know, like, what is this CrowdStreet thing? So we have a ton of great content out there to create this inbound demand generation for people to find us. And even if don't even know that they're looking for a real estate investment platform. We also do traditional advertising. We spend money on social networks like Instagram and Facebook. Those are trickier, more expensive, and a little bit more of a shotgun approach rather than a rifle approach to targeted advertising. And then, for example, tonight, I'm taking this Cella back into Manhattan. We have 100 people meeting us at the Skylark. And so we do cultivate community in person as well. We spent a half an hour speaking about what's going on with the business and where they will see future opportunities, what we like in the market, given where we are. There's been such dramatic change in the investment universe. So we do a multifaceted, multimedia, online, offline way to get people to find us, to join our community, and then to make one or more investments from there.
Are there any market misperceptions about crowdfunding that you would hope would change? LCP's background history is real estate syndication, which from my view is just what crowdfunding is, but through an efficient technological platform.
That's right. That's exactly what it is. So syndication has been around since the beginning of this country, right? I read a story once that the Statue of Liberty, the base. So France gave America the Statue of Liberty as a gift, and we didn't have enough money to build a pedestal to put the Statue of Liberty on top of. And so it was crowdfunded. It was just like they passed the hat and people chipped in. It was a donation-based crowdfunding service. But I thought, that's a cool story. So it really has been around since the beginning of the country. Places in the country where, like Texas, oil and gas, that's how they drilled the first oil and gas wells. It wasn't like that many major corporations. It was a bunch of cowboys passing the cowboy hat and drilling a well to discover where oil was. And so in certain areas of the country, it's very, very popular and normal. And so using the technology through the internet, of course, 20, 30 years after the internet really became into existence and was proven in other commercial applications like stocks and bonds, we have brought it to private real estate through the Jobs Act, made that possible again. And I think there's a couple of things that come into mind for like the perception. One is in our early days, there was a lot of skepticism. There was fear that people would lose money and that there would be unethical sponsors that would make their way onto the system and raise money online. And you always hear the warning signs of just wait until grandma loses her money in one of these online fundraising schemes, and then it'll get shut down. Well, of course, like the industry needs to operate in a way to prevent that from happening. But we found that it happens less through a highly curated professional site that has this network effect, and the crowd is a knowledgeable place. So if somebody were to, pass, I'll speak like a highly curated site, but let's just say somebody makes it through the vetting process and the background checks and the reference checks, and somehow makes it through, right? And we, or we announce it, and then we've got like hundreds of thousands of people, who could basically be like, hey, I don't know if you know this, but like, that person did something wrong, right? Oh, really? And we've actually had that happen once or twice. So the wisdom of the crowd actually reduces the incidence of bad actors and the incidence of we don't want grandma to lose her money. And we go to great lengths to make sure that between our internal resources and the wisdom of the crowd, we work with quality people who are professional. And they're fiduciaries. These sponsors, they're fiduciaries of capital. And they have a huge responsibility to do the right thing for investors. And we stick around also to make sure that they're following through on their business plan. We read the reports, the quarterly reports. We compare them to the projections, and we read the reports, and we look at the financials, and we're trying to do the right thing for our investors. And I should say this, that when we started the business, as I mentioned, we started at 4 investors, although sponsors are a hugely important customer. We had 2 customers. We actually have 3 because now we have financial advisors as well. In 2018, we created CrowdStreet Advisors so that we could actually tell people how to build a diversified real estate portfolio that matches their criteria versus somebody else's criteria. And so we're a registered investment advisor. We're also a broker-dealer. We take these things very, very seriously. The responsibility of being a financial advisor, the responsibility of working with the SEC and FINRA to live up to the high standards set by those government agencies and to do the right thing for investors. But our mantra, even in the very early days of the business, were do what's best for the investor always. Always do what's best for the investor. That's why the sponsors come. Because if we're the right place for the investor, we provide the right service and the right offerings, and we help them build this portfolio, and we'll have a lot of money then because of all these investors. We're the chosen platform. Well, then real estate sponsors are going to come to us. And that was our plan of attack from the beginning. That was our business plan. That was our mantra. And that's truly what we believe in every day. We ask ourselves in times of even really, really difficult decision, well, hold on. What's in the best interest of our investor here? Let's start there and then figure out the details.
So let's go to the students, the investors here today. What are your questions?
Yeah, you talked about some of your customers. Is there a minimum net worth, or do the investors have to be, is there a minimum amount of capital they have to invest?
Yes.
What does that look like?
So Davis, the reason why we work with accredited investors is actually due to that regulatory and compliance rules. And what the SEC is trying to do is protect investors. And through the private real estate space, they say if you're an accredited investor with a certain net worth threshold or income, annualized income, then you can participate in these deals. And the sponsor can accept you. And so the SEC, trying to protect investors, actually makes it a little bit more exclusive, which is, I guess, in some ways good, in some ways, not inclusive, right? And when we started the business, to be honest, like, I didn't even think about like, students, versus very wealthy people. I kind of was gearing it more toward the middle class. I just thought, like, at some point, people take an interest in investing, and there's, this is a good thing for investors, right? But as we started to build out the business, we realized due to the regulatory and compliance arena that we're operating in, let's build the business with accredited investors, and that is helpful because they, invest more, they can write bigger checks. CrowdStreet could have, tens of thousands of investors like we do today, 19,000 active investors, and not like 190,000 smaller, investors to service, because customer service actually plays a role in that as well. So a couple of reasons why we work with accredited investors still today. And yet there are some platforms out there that service non-accredited investors. So basically everyone, the middle class, the mass affluent, or just anybody that wants to put $100 in a real estate deal. So I'd encourage you to check out some of the other platforms out there, because there is a way for all of you to get started today, and I can point you in those directions. Yes.
What's the range on the deal size?
So the property value size, as small as $20 million, And so let's say they get a 50% loan to value, we can raise 10 million. I mean, we've done deals smaller in the $15 million range, but we try to steer toward more of an institutional caliber and quality of product, along with a more institutional quality sponsor. And so the deals on the low ends are 15 to 20 million. On the highest end, we've done deals in the hundreds of millions of dollars of the property value. We are a small sliver of the equity required at that point. And so the sponsor will maybe need, let's say it's a $300 million deal, they need $100 million. And they could bring in one of those institutions I mentioned earlier, right? They could bring in lots of friends and family. They could bring in sovereign wealth funds. Maybe we participate, our equity is part of the sponsor's portion. Usually the sponsor needs to have 10% of equity into the deal, and sometimes we help syndicate that 10%. So it's a pretty broad range, but the theme that you'll find on CrowdStreet is very sort of institutional quality in nature and with the operator that we're working with.
Thank you for coming and speaking to us. I was curious about your due diligence process. So I'm assuming you look at the sponsor and the deal. Which do you weight higher? And I know you mentioned track record. What are some of the other things you look at when it comes to looking at sponsors?
Yeah, it's the key to our success. And we sponsor first, and we look at the track record, and we confirm the fact that they actually own. We ask for like title and deeds and so forth, so to confirm they did what they said they're going to do. The nice thing about operating at this high level within the industry is that most people know each other, right? And so we do reference checks, and we get a lot of information just by being really kind of everywhere across the country. So sponsor by far and away the most important thing for us. Number two is property. And the plan on the property, right? Whether it's a ground-up development or an acquisition or a repositioning or a gut rehab of an office building to make it into an apartment building, trend that we're reading a lot about due to the forces in those markets. And then the investment structure. And what I mean about that is the pro forma or the financial projections. You'll notice the word target is used 4 times. And it is all a projection, right? And so we get into the weeds on the quantitative analysis of a deal, because it could come down to, somebody thinks rents are going to raise this much, but the data says it's going to be a little less, and so we want to know exactly how our view of the economics are going to work. And so those are by far the biggest elements, and by far the biggest thing is the sponsor that we're working with. We are a passive investor, and so we really are most concerned with working with groups that we think are going to protect our best interest as well. We felt that way about Francis.
I would just add to that, we also, beyond the vetting we get from CrowdStreet, the investors do it too when they look at the deal, and we field a lot of questions that make us better in our own underwriting. Just so kind of sourcing that crowd. We're not just dealing with the CrowdStreet executive team, we also, the investors, bring their questions to the deal too.
Yes.
Again, thank you for being here. I'm curious to hear your thoughts on whether you see opportunities in attracting international investors in the format of crowdsourcing, despite regulatory difficulties, or no?
Right.
I'm so glad you brought that up, because I was going to talk about that at lunch with him.
Yes. So absolutely, we think this is a global business. It's definitely a global trend, and we have not tapped into any international investor capital. When we do that, I should say, we'll have to decide, which country comes first. It could be through an inbound inquiry. I got a call from a Japanese firm that's really loved what we were doing. They wanted to create CrowdStreet Japan, and so we could expand to Japan first, or any country that we've got. There are some platforms in Germany, so that could cause. It could be a partnership-driven opportunity to expand. If it was just us going organically internationally, we'd probably do what most U.S.-based multinational firms start with. You just go to the friendly Canadians up north, and you start there, and then you expand maybe to the UK or go down to Australia. And so there is a method to the international expansion. You are correct. One of the reasons why we have not broached it yet is because it's complex enough here in the United States from a regulatory and compliance point of view. And once you start going internationally, it is multitude of complexities there to manage. The other thing is we're still just a drop in the bucket. We still have so much growth opportunity here at home that we will continue to do that, so as to not, take our eye off the ball and allow somebody else to take the leadership position that we've worked very hard to gain. So, but yeah, that's how big this opportunity is. I mean, it's just absolutely gigantic. Yeah.
Thanks for coming. Regarding the capital stack, you look at deals with the same type of capital structure, the amount of leverage that they have, or do you source different deals with different LTCs or LTVs for different type of investors?
There are trends, right? 70, 80% leverage. Now it's coming down. I think the banks are willing to lend, if at all, less in terms of a loan to value. And then we do look at it on every single deal that we look at, make sure that not only the loan to value, but like the loan terms. In fact, we have seen recently a delay in a lot of projects that we conditionally approved. We agreed to raise capital for them and invest capital in the project pending the term sheet from the bank. And we have seen a lot of those term sheets vaporize. The banks are like, oh, we're sorry, we're not doing that. Or here's the term sheet. It's going to be, 200 basis points higher than what I told you 3 months ago. Or there's just, it's very expensive and very difficult to get debt right now. We think that's going to ease up here in the latter half of this year, but it's a reason for, yes, we hope so. It's a major issue right now, so we look very closely at it. Yeah. Yes.
I have 2 questions. First, if you can share some of the performance of the current IRR and cash flow from the investment that is working and how it's compared to projections. Mm-hmm. The second one is, who is eventually the owner of the asset? Is it the investors, the small investors, or it's CrowdStreet?
Yes, it's actually the sponsor in our business model. So you would buy $25,000. You'd be buying shares in this company. It's an LLC. And Francis is the managing member of that LLC, that company, which is a company within a company. That there's a larger sort of parent co that owns the property. And you would be on the cap table, a $25,000 investor along with 133 other people, so let's say. So yes, he's the managing member of the company and the owner of the property as well. And back to your first question, which is the performance of CrowdStreet since inception. We've done 750 different real estate deals. Some of those have been small portfolios. Most of them have been single assets. And we've raised $4 billion of equity into something close to $30 billion of real estate value. And 150 of those deals, we track them all again, and we know what's going on in every single deal that is still live. 150 of them have been sold or recapitalized, they've been realized. And the performance on those 150 deals resulted in a 19.7% net to investor IRR. So the project level returns were higher. Then there's the fee to the sponsor, there's the promote to the sponsor, other closing costs, and the net to investor returns have been 19.7% across 150 plus deals that have been sold. It's an equity multiple of about 1.6. The average hold period has been 3 years, and I think those are the key statistics on how the portfolios perform. There's a question up there.
On this example, the minimum investment of $25,000, max $250. Is that coming from LCP or CrowdStreet?
Those are CrowdStreet investors. So the average investment was 45, the minimum was 25, and then a single investor on CrowdStreet put in 250.
So it wasn't like you as a sponsor said, hey, this is the minimum.
No, we put in 715 came from my partner and I, And then the delta between the 6 million that was raised and the 6.3 came from employees of ours who also invested in the deal, employees and advisors. So we were in excess of the 10% total. Do we have time for?
I think we have time for maybe one more. Yeah. Maybe two. I think.
Yeah, two more.
Sure. Thanks for the talk. My question is on, as an investment strategy right now, if the rates are fairly high in terms of policy rates, is it better to go for an investment that has like a larger part of its cash flows tied to terminal value? Because those terminal values are calculated on cap rates that are into the current rates. So say 7.5% maybe prevailing cap rates right now. And if those cap rates are lower, say at exit at some point, would that give you some potential upside by being in that type of a real estate investment process?
That's right. Yeah, cap rates and values have an inverse relationship. And so if today's cap rates are higher because they went up, and of course it has to do with the property type, right? Office, class B, standard office, that's nothing very interesting. Those cap rates are pretty high. Some retail cap rates are higher. Even hospitality cap rates are slightly higher than multifamily, for example. So it has to do with the asset class. It has to do with the interest rate environment. It has to do with just demand. It's like buyers make the market. And so when buyers are not as active, you do see cap rates as they have been recently trending up. And then 5 years from now, if cap rates are lower, that's going to juice the returns. And that's why for 20 years, we had a declining interest rate and cap rate environment, going down. And so a lot of real estate was outperforming projections strictly because of the cap rate compression that was happening, causing an increase in value. It was a good time for the last couple decades.
I would just add to that. I'd say today, the market is still in a moment of uncertainty. So there's a delta between going in cap rates, sellers, especially on cash flowing assets, are not willing to sell at the cap rates, the prices where these properties could be financed, and they don't have to, for the most part. On underwriting exit, what I'm seeing from ourselves, our partners, is you're underwriting traditional exit cap rates that you've seen the past 5 years. That's great if you believe interest rates are eventually going to come back down again and normalize. If we're continuing in this environment, none of these deals are set up for these interest rates. So if you have a loan maturing this year, you have a problem. Mm-hmm. And a lot of those problems will be resolved because there's so much capital in the environment that they'll right-size the loan. So we have a hotel that came due. We paid the loan down. We got 2 more years. But it's a very uncertain environment to invest in real estate. So we've pivoted to debt. We're making a loan on a hotel that is fantastic and cash flowing at 70% at SOFR plus 7. That's an 11% loan on 70% LTV.
That's awesome.
We'll take that all day.
Yeah.
Because we can't make an equity deal work. So it's a very strange place to be. I think 2 weeks ago, people were very hopeful that at the end of this year, certainly beginning next year, rates would start to come down. But when the inflation numbers came in again, the markets went into a little bit more of turmoil, and we're back in this uncertain mode. So transaction volume will probably be very low for the first half of this year.
Right. Great point. Great time to be a lender. Smart pivot. Yeah.
My question actually dovetails exactly with what you were just talking about. I was going to ask you about the current economic environment. Interest rates are really high. It's unclear right now what the Fed's plan is. A lot of people are projecting a recession towards the second half of this year. Francis kind of just touched on some of the challenges, but do you also see opportunities potentially for CrowdStreet in that environment? Or how are you guys preparing for that kind of economic environment?
Yeah, there are great opportunities, and we do have this big portfolio that we're tracking very closely. We have some issues given with the performance of the properties and the expiring or floating rate debt causing a lot of capital calls to occur, and so we have to manage through that. But at the same time, it's pretty exciting because of the opportunity for buys, right? Buying low and even taking care of some of the distress in the market. So having lived through the great financial crisis and been in the real estate market at that time, it was the purchase or the buying opportunity of a lifetime. I mean, I don't expect anything like that. I hope I don't experience anything like that again in my lifetime because there was so much pain involved, but it taught us a lot. And it taught us to be, opportunistic and swift when we see good opportunities. And so in that sense, it's really exciting, this current buying opportunity. But we don't want to pray, we don't want to bet against the American economy. We do not want to, wish other people hardship. But we also are capitalists, so we'll take advantage.
Yeah. I would just say one other thing on that is you got to look at the pro formas and the operating margins. Most of the people who are producing these numbers don't have gray hair and have never experienced inflation. And so they're saying, okay, well, my rents can go up, but they don't change their operating expenses. So the next 5-year pro forma is very important to look at and look at the margins.
Yeah.
And if you're taking my real estate finance course, we're going to be exploring how to do this type of forecasting in the second half of the term. But we're out of time, but thanks again to Darren.
Thank you.